Okay, let's take a look at this quick vertical analysis for an income statement. It's problem 15-2B. And I'll read the problem and then we'll work this one relatively quickly actually. For 2008, what is this? Acadia Technology, if I've said that right. The Acadia Technology Company initiated a sales promotion campaign that included the expenditure of an additional $10,000 for advertising. At the end of the year, Gordon Kincaid, the president, is presented with the following condensed comparative income statement. Okay, and even though it's a little bit small, you can see it on the screen here, right? So we're presenting the income statement. 2008 to the left of my mouse appears first, then 2007. And our instructions are to prepare a comparative income statement for the 2-year period, presenting an analysis of each item in relation to net sales for each of the years. And that makes it a vertical analysis as opposed to a horizontal analysis. Round to 1 decimal place. And then on part 2, we'll comment based on what the data presents and what was revealed by the analysis we've prepared. Okay, so now what I want to do is I want to slide down and show you that what we're going to do is prepare an income statement for the 2 years. Okay, let me get this up as much as I can, then I'm going to slide this down. We'll start right here where we can see the instructions and part 1. So there's problem 15-2B, and you see all we've done is copied the information, right? We've prepared a comparative income statement, and we've copied the exact numbers from above. And then when we're putting together a vertical analysis, it's really straightforward. Let me slide this one. Actually, why don't we do 2007 first, right? We have to come up with net sales at 100%, so let me slide this out of the way. And if net sales is 100%, then everything is based on that $670,000 to the right of my mouse there, right? 670 divided by 670 is 100%. 676 divided by 670 would be 100.9%, right? And then you just sort of do the same routine everywhere else. We would take 274 divided by 670, and I'm talking in thousands now, $274.7 thousand divided by 670, and that would give us that number to the left of my mouse, which is 41%. Okay, 100 minus 41% gives us 59%. Or you could take the 395,300 to the left of my mouse, divide it by the 670,000, and you'll still get 59%. Okay, use the same technique to fill in all of both years. And that's really all there is to putting this one together. So what we can see is that if we're basing things on 100% and doing a vertical analysis, what we see is in 2007 we made 16% net income, bottom line, and we improved it over 2008 to 20%. Let's look at some other key items. Income from operations. Look at that. We're seeing that 5% or 4% improvement from 23 to 27. Sales returns and allowance even went down as a percentage of net sales from 0.9% to 0.7. Okay, if we slide a little bit more, we can tackle the author's approach to the commentary. And why don't I do that? And what he says is, or what they say, I believe we've got more than one authors in this textbook, is that the vertical analysis indicates that the costs, which would be represented by cost of goods sold, selling expenses, and administrative expenses, as a percentage of sales improved from 2000 to 2008. And we see that because of that change of 16% to 20% improvement to net income. Okay, we also see the improvement because we talked about it, right? 23 to 27% of income from operations and the cost are made up in there, right? They're included in there. Okay, so the sales promotion campaign, but just based on this information, looks like it was successful. The selling expenses as a percentage of sales declined, right? We went from 24 to 23%. And that suggests that the increased cost justified, or the increased sales justified incurring the increased cost. And that's this problem, everyone. Thank you.